in managing infrastructure securities on behalf of Southern investors. His coverage includes railways and utility sectors. He used to be portfolio manager for Challenge Infrastructure. He's worked in London and Global Equities, JP Morgan, and holds an MBA from the Australian Graduate School of Management, chartered accountant as well. Also joining Trent up on our screen is Vincent Cook. Vincent works with Clime as a portfolio manager. He has 15 years experience in the Australian equities market, working as an analyst and portfolio manager with Clime. He's primary analyst for large cap stocks at Clime and is portfolio manager for the High Conviction Strategy Fund. CFA charter holder, Bachelor of Laws, enduring passion for sport, exercise, and competed successfully in Australia and overseas in karate. Now, I will introduce our friend from Alliance Bernstein when he joins, so we can get straight into it, Roy Maslin. Roy's the Chief Investment Officer of Australian Equities. He was appointed CIO with Australian Equities in 2012. Previously CIO, Director of Research. Has worked at McKinsey Company, worked in Australia and Europe. He spent 4 years with Rolls-Royce Aerospace as manufacturing strategy researcher, and he holds a PhD in manufacturing strategy from University of Cambridge. So without further ado, Garry, I will now switch over to you.
Thank you, Mark, and welcome, guys. And I want to start the presentation just by making some comments about the particular managers that Mark and the team have selected and why we chose you three. One of the things with the FASEA code that advisors would be full aware of, and we've just had a compliance session about ensuring you dot your I's and cross your T's, because in retrospect, we can cop a lot of criticism by the regulators and so on. And one of the very important aspects of being a good financial planner is obviously selecting the right underlying investments, whether you're doing it on a direct basis or whether you're doing it through managed funds, listed investment companies or ETFs. And the three companies we've got today is in some sense what we're doing is we're doing some sort of a due diligence discussion. But more importantly, I think what this is doing something you as an advisor should do on a regular basis, and that is understand the managers that you're selecting in your investment portfolios and question them about what value they add and why they should be represented in portfolios that you recommend. The first point I make in that respect is the reason why these three are here is because we've already done that process, and we believe these three particular managers should be part of your portfolio, but my point is that I would really like to encourage you to do that process. And some of the questions I'm looking to ask today of the manager is the sort of things that I think you should be looking to do when you're speaking to the practice managers that come out from the various companies, or when you contact the investment managers direct, so that you truly know the managers you're recommending, you know what to expect from those managers, and you can sleep very quietly at night knowing that they're doing the particular job that their particular funds suggest they do. I thought what we'd do is we'd start off with spending, say, 5 minutes with each of the managers on a particular thematic that a lot of the markets are talking about. And there's three thematics in particular that we believe we would like to share and get some input from the three speakers. One is the shift to renewables. Clearly the market has had a lot of attention. The Australian government is overseas at the moment in respect to climate change and emissions and all those sorts of things. And there's been a big shift in the investment paradigm to renewables. So I'd like to certainly talk about that subject. The second one is that governments around the world in COVID have been printing a lot of money, and they've been really pushing the economy very significantly to try and get our economy up and running, and the impact that money printing is having on asset pricing, funds, also back in the past, but also in the future. And the third one is, as we see, Melbourne today, we're reopening tonight, and some of you are going to get off this call and go out to the restaurant for the first time for 260 days or something. And what sort of impact and opportunities are there in this global reopening as we all come out of COVID? So I might just firstly go to Trent and talk about the shift to renewables. So what are you seeing at First Sentier in that respect, and how you're looking to take advantage of that for your funds?
Great, thank you, Gary, and good afternoon, everyone. Thank you for the opportunity to be here today. Very quickly, before I talk about renewables, just to remind everyone what it is that we do at First Sentier. So my team, we manage a global listed infrastructure fund. So if you look today around the world, there's around 300 companies that broadly meet the definition of being infrastructure. We screen it down for a variety of reasons to around half that number, and then we're building a portfolio for our clients of around 40 to 50 of the best infrastructure opportunities we can find globally today. That portfolio includes a range of different assets. About half of it is utilities. About around 30% fits into what you could call more of a transportation bucket. So that's, think of roads, airports, railway companies. About another 10% is in more energy infrastructure. So think of pipeline, storage terminals, and then another 10% in what we call communications infrastructure. So mobile towers and even data centers is one of the more recent additions to our universe. Coming back to your question, Gary, around the shift to renewables, clearly it's a transition that's being talked about for a long period of time, but it's probably accelerated even in the last 12, 18 months with COVID. We're seeing countries around the world trying to make commitments around net zero 2050. Companies are doing the same. Australia is on its way to doing that. It's now been made, that commitment has been made at a state level by each state. And the hope is, and the likelihood outcome is probably that at a federal level, we'll also come out and make those commitments. But what that means for us as infrastructure investors is that we're essentially really at the forefront here. These utilities that make up about half of our portfolio, they provide the gas, the electricity that we use, the water that we use each and every day. Historically, a lot of that electricity and gas, the electricity has been generated through fossil fuels, and the world is trying to move now more and more towards renewables. So these companies are going to be at the forefront of that. For the ones that have their head in the sand and are left behind, it's going to be a real threat. But for many of the companies we're favouring, it's actually a real opportunity, because that growth, that capex that they have to spend, is being captured in their rate base and is generating additional regulated returns for our clients, and ultimately is driving the outcome that society and governments are looking for. So it's a fascinating time right now to be investing in infrastructure, and I think it's a great opportunity for your clients to get exposure to a structural growth story that's going to play out not just for the next few years, but for decades to come.
Yeah, no, it's a very good point. And you mentioned that you're a listed, so the access into your fund is listed. I know a lot of the master funds have, Colonial, First State, First Sentier Fund, and a number of other master funds also do that. So where is the normal way to access your fund?
Yes, and so maybe I should have even started with that. So First Sentier, I think hopefully most of you are now familiar with the new brand. It's the old Colonial First State Global Asset Management. We've been managing a listed infrastructure fund for around almost 15 years now, since 2007. It's not a long time in equity markets, but it actually makes us one of the longest standing listed infrastructure managers today. The benefit, the reason why it's now so exciting for investors is that historically, the only way you could really access or invest in infrastructure was directly by investing very large pools of capital. And that tended to be limited to the big pension funds, the sovereign wealth funds, who would go in and buy 5, 10, 20% stakes, spending hundreds of millions of dollars. Now, as this asset class has continued to grow, your clients can invest in an infrastructure fund like ourselves. It's a managed vehicle. It's on most of the platforms here in Australia. And it's got daily liquidity, so you can buy in and out of it as you choose. And you've got access to what we see as being the 40 to 50 best investment opportunities globally within that space.
Fantastic. And welcome, Roy. I see that your microphone is off, so I'm assuming you may have arrived. Maybe not. No, thank you for that, Trent. And Vincent, I might move to the second one of the other questions that I'd like to cover is, we're in Melbourne tonight. We're going to be celebrating, and we're seeing a global reopening around the world, and many countries have actually seen sales in retail stores and also things really kick. I saw that in Sydney a few weeks ago, and Kogan had a good report recently in respect to the global reopening kicker. What do you see? Do you see the reopening as a risk, or because people have factored a lot in, or do you see this as a future opportunity? And what are you doing in respect to your big cap fund at Clime? You're on mute, Vincent.
Yeah, there's a lot of different dynamics in play and things happening as the situation evolves, and reopening plays have led the market this year. I might just make a quick couple of comments on the way Clime invests, and then delve into that question if I can. So Clime's been around for 25 years. We're an ASX listed company under the ticker CIW. I've been working in Aussie equities for 16 years and at Clime since 2017. Clime's heritage is in value investing, and that's evolved over time to a focus on high quality companies, applying a valuation discipline. So we look for companies with low gearing, strong competitive advantage, which is often reflected in high margins and high returns on capital. We have a high conviction approach to investing with relatively concentrated portfolios. For example, our smaller companies fund currently has 24 stocks. You'll see a lot of funds managing portfolios of 40 or 50 stocks. It's a feature of the Australian market, and as a result, the portfolios of the largest investment groups that they're heavily weighted to the largest companies. So the ASX 20 currently accounts for 50% of the All Ords. Clime's investable universe, once we take out pre-revenue companies and the smallest micro caps, is around 700 companies, and many of the more exciting opportunities are outside those largest companies that dominate the index. So our strategies include our smaller companies fund, our income fund, which are widely available on the platforms and are both comfortably top quartile in investment performance over the last few years. And then we also have all cap strategies, which are managed through SMAs, unit trusts, and our listed investment company, Clime Capital. So back to the reopening. So as I said, reopening plays have driven the market this year. Travel stocks are up 30 to 40%. We think some reopening stocks will continue to perform well. Australian consumers have that massive amount of savings that have accumulated over the last 2 years, and they're still constrained from their spending on travel and some activities, either through restrictions or through their own reluctance. In the travel space, we do have a position in corporate travel. We think they've made a transformative acquisition in the US. They've still got a very strong balance sheet, and there's room for growth there. Their business has recovered in Europe to pre-COVID revenue levels, and so we like the opportunities there. We think consumer discretionary in general will perform well given the factors that I talked about, but we also think the market's underestimating some of the lasting impacts of the pandemic. I mean, a side anecdote is that Sonic Healthcare's forecasts keep getting upgraded because this PCR testing just remains a feature of things. And, if it becomes part of the travel landscape or the travel process for reopening, 40 million international arrivals and departures into Australia each year, if they use PCR testing, which is what the industry supports in Australia, then that will keep a boost for that business going forward. But also in the household goods and housing related market, so it's been a paradigm shift really in terms of the way people are using their homes, working from home, spending a lot more time there. So people are spending more on their homes. So retailers that are leverage to that, now that they've got their shops open again and consumers have money in the bank, we think they'll continue to perform well. And then they've got the nascent tailwinds of the housing market. The housing activity turned down in about 2018, and the recovery was cut short for a time by the pandemic, but activity levels building, and completions will be coming down the track, house prices up, which has that wealth effect. So we think those retailers will continue to do well, but we're also aware that we're going to come out of a period of supercharged growth into more normal growth, and so we think there will be a shift back towards quality at some point. That's always been a focus for us. So we like quality stocks where the valuations aren't. You've got to be wary of speculative prices in at some points in some stocks and assets these days with the environment that we're in. But companies like ResMed, which is everyone will agree is a very high quality business, and they've just got a really unprecedented opportunity for them at the moment with the Philips recall, which has basically taken them out of the market for currently estimated to be 15 months of not servicing any new customers. So provides a great open playing field for ResMed to capture market share, which they were already doing before this happened. But I'll end my comments there.
Yeah, no, it's some good points. What do you think on the difference between the Australian economy and the international economy in respect to this global reopening? Are you being more specific to Australian investments only, or do you think that we'll follow the same as all the other countries, or do you think as an island we're a bit different?
We are a bit different as an island. We thought we'd got the gold medal at the start with our low incidence rate, but then the virility of Delta has proved that you can't escape it forever. So then we've been caught in a position of being behind the rest of the world on vaccination, but we've done a very good job of catching up there. We're approaching the UK's level of vaccination, so we are following the same track in terms of transitioning to living with COVID. But I think we will lag in terms of the travelling, just because we're so isolated, and there's a desire both by the public and leadership, government leadership, to take some care there. So I think the driver of consumers spending their dollars onshore will persist, notwithstanding that everyone's got a desire to take some holidays. But I think there'll be a persistence there.
Yeah, no, I agree. Trent, you wouldn't know this, but I've been outspoken on the challenges of industry superannuation funds and their pooling, having pooled funds. And one of the concerns I've always had is their pricing to market of unlisted investments such as infrastructure and so on. What's your view on the risk for large pooled funds, and where do you differentiate yourselves in respect to investing in infrastructure where it's challenging to price to market on a sort of daily unit basis?
Yeah, so I guess a couple of questions in there. So as a reminder, so we're investing and we're only buying into listed infrastructure assets. So these are companies like a Transurban, like a Sydney Airport, that are already on listed markets and are getting priced each and every day. So you've got that liquidity, and essentially, if you're buying into a managed fund, you've got that pricing that will be done each and every day. I think the challenge, and probably your question where it's more focused on, is when you're investing in direct assets, so unlisted infrastructure funds, where valuations are typically done maybe twice a year, at most maybe every quarter. So what you're seeing there is that you've got valuations which are being done, say twice a year, every 6 months. And despite what might be happening in that period in between, and a COVID was obviously a good example of that, you can have material changes in some of your assumptions, which may therefore impact the valuation. The argument, I guess, against that, though, is that these are very long-dated assets. So even if you're investing in a Transurban or a Sydney Airport, you've got concession agreements that go through 30, 40, 50 years into the future. So even an event like a COVID, whilst it's had a very big impact on your volumes in the near term, doesn't have as material an impact on the valuation over the longer term. So the super funds have been able to, I guess, look through some of the day-to-day noise that you see in listed markets. Now, for us as investors, that can actually create the opportunities. And if I use what happened with COVID last year as a good example of that, we went into COVID only with about 3% of our portfolio invested in airports, not because we knew a COVID or anything like that was going to come, but we just felt valuations were looking full in the sector and we're seeing better opportunities elsewhere. What happened in March, April was you saw the share price of those airports, like a Auckland airport, fall by as much as 40% in a very, very short period of time. We've always liked the quality of those assets. We've always wanted and would have liked to have owned them. We just felt the valuation was too expensive. So that gave us an opportunity to buy in at a lower price. So we have that you can have that opportunity in listed markets, but clearly you also have the daily volatility. So there's no right or wrong. I think there's an opportunity for both in clients' portfolios. But for us and what we manage, we have that daily liquidity anyway through being in listed markets.
Yeah, and I think that is a tremendous advantage of your product for our investors because as we talked about in our previous meeting on compliance, liquidity is such an important thing for the retail investor, and the fact that you've got the opportunity to invest in timeframes of 10, 15, 20 years, but have daily liquidity pricing, I just think you really are a tick box for that sector of a portfolio. So, I think what you've come up with, that solution over the last 10 years has been terrific.
Thank you. Yeah.
I might get you guys to share this question. Roy's been trying to get in and out of the meeting non-stop. I'm not sure he's coming, but maybe one of you might like to have a crack at your opinions on this global money printing of that's been taking place all around the world and its impact on asset pricing, and whether you think that when it slows we might see a bubble, or actually we'll see a continuation of that.
Vincent, do you want to take it on first?
Okay, yeah, I'll make some comments first. I think you can't say it hasn't had an effect on asset prices. It certainly has. We're finding, in our models, we obviously don't use 10-year bond rates where they are today. We've made a downward adjustment, but it's more like 100 basis points from where we were a few years ago. And we're still finding companies that trade at a discount to the valuation we find there. So we don't think there's a widespread massive bubble across the equity market. We think that most central banks are committed to maintaining the stimulatory monetary policy until we get wage inflation ticking up, which in Australia there's no real sign of that yet. Sort of 1.7% was the last statistic I saw on wages growth. So the RBA wants that to be 3%, and they think that'll take some time. Notwithstanding that, we're certainly having inflationary forces from the supply side shock at the same time as we've got demand boosted by stimulus. So we're going to have to see how that plays out. But I think the supply situation should be able to resolve itself in a relatively short period of time compared to the way that we think about the market. I think, the chip shortage, for example, I think there's expectation that, first quarter of next year, there'll be a significant increase in supply. And I think, the demand impulse will wane as well over a similar time period. So some of these things should prove to be transitory. That's the buzzword that's been flown around. But I guess, it comes down to human behavior as well and whether inflation expectations change.
And maybe just a few points from our perspective. So we're, as I've talked about, we're investing in very long-dated assets and forming a view on what we think they're going to be worth over the life of their asset, the concession agreement, and then discounting it back to what we think they're worth today. So whilst what's happening in day-to-day markets from a macro perspective is important, we're also taking that long-term view when investing. For us, we look at what's happening with interest rates is going to be important when you're valuing assets over a long period of time. Those interest rate expectations have started to rise, and that can be a headwind for real assets like infrastructure or property, where you've got now a higher discount rate being applied. But I guess the question really to be asked as well is, why are interest rate expectations starting to increase? And for us, a lot of it is being driven by higher expectations around inflation. I know Vincent mentioned some lower numbers here, but in other parts of the world, and remember, we're investing globally, you have started to see real signs that inflation is picking up, that it maybe isn't as short-term as everyone thought. So that's an environment where we feel that infrastructure is actually going to be well positioned. And the reason I say that is, for us, around 70% of the assets we're investing in, inflation is a direct pass-through. So if you're a utility, who ends up paying, if inflation here goes from 2% to 4%, who pays for that? It's your mum and dad investors. It gets directly passed on to the end customer. So that ability to have that pricing power to be able to pass through higher costs like inflation is going to prove to be, we think, very, very important going forward. And that's why, yes, clearly it's going to be a headwind as rates go up, but if it proves to be more and more due to higher inflation, then that's an area where we think we're going to be well positioned. But yeah, clearly governments are printing lots of money. They're all trying to achieve the same outcome of stimulating economies after a very challenging time. And there is a risk of valuations creeping up in some parts of the market. There's no doubt.
Yeah, one of the stocks that may or may not be in your portfolio, Trent, is Transurban. Transurban for a long time has been considered sort of a darling of the market because of its perception of paying high yield. The reality is that it really doesn't pay high yield, and it pays it from debt. What's your view on Transurban? You know, it's got high debt. Do you think interest rates will impact its ability to pay the forward yield that the market has sort of fallen in love with?
Yeah. So Transurban is a company obviously we're very familiar with. It is one that we do have in our portfolio. In fact, it is one of our larger holdings. And if I talk through the reasons why we think that, this is firstly, we're all familiar with the assets. I think everyone here on the call is located in some part of Australia, so they own largely the toll roads across Brisbane, Sydney, and Melbourne, and they do have an increasing exposure now to also some US toll road assets. There's a management team that we rate highly, and they've put in place contracts, long-term contracts that do have that link through to inflation, and have proven to provide good steady income over many years. The leverage is higher for that business than for other infrastructure companies that you may look at. We would argue, though, that that's largely tied back to the nature of the cash flows behind it. They are very generally steady, stable assets that you are able to borrow against. They did learn some very hard lessons through the global financial crisis, a lot of these toll road operators, and we saw that here in Australia with the builders of the likes of the Cross-City Tunnel in Sydney, building an asset and making some unrealistic assumptions around traffic, and that essentially that road going bankrupt. Now, Transurban ended up picking that asset up at a very cheap price, but that's not a good outcome when you see equity being lost. So Transurban today is much more disciplined. If you look at their refinance risk, they've actually locked in their debt now for over the next, I think on average, it's about 12 to 13 years debt maturity. So what that means is debt has been locked in now at very low rates. And even if you do start to see rates pick up, those interest costs aren't going to move up sharply in the near term. So it's definitely you're asking the right question there, Gary. Leverage is absolutely something you've got to think about when investing in these companies. But I think given the strength of the assets they've got, the management team behind it, the nature of the contracts they've got, and the framework, the regulatory framework that it sits within, with being in the Australian market, we still think it's going to prove to be an attractive place for investors to put their capital. You should think about it as being broadly around about a 4% dividend yield, 4 to 5% dividend yield, and it's the earnings growth, the 5-6% earnings growth on top of it that it's able to deliver. Yeah,
excellent. I might go back to another stock from you, Vincent. And again, I don't know whether you own it or don't own it, but you met and we were talking about the global reopening. Flight Centre came out. Sort of Flight Centre had a bit of a pop in the last month or so, and then sort of pulled back in the last couple of days and made a statement to market that they were losing $40,000. Sorry, some huge amount per week. What's your view on Flight Centre? You said you own Corporate Traveller, which is quite different, but Flight Centre?
Yeah, looking at the travel space, we decided to stick with the corporate focused travel. I think out of the ASX listed travel stocks, Corporate Travel is the one that's gone back into profitability. I think also in terms of the relationships with the airlines, the airlines obviously been hurt just as much as anyone else in the industry, and they've pushed back more in the leisure space than they have in the corporate space on the margins there. We also prefer overseas exposure rather than Australian exposure because the rest of the world is more advanced. And Corporate Travel's got the consolidation opportunity for it, so it's now the fourth largest corporate travel provider globally. Right behind some really big companies like Expedia, but the industry overall remains highly fragmented. So weakened competitors, I think they'll gain market share in the US just by virtue of the new and large business they have. They've now got full geographic coverage on both coasts. They've got proprietary software that they use for their booking platform, which 95% of their bookings come through. So I think they're well placed as a real leader now to participate in the consolidation. And I think the corporate travel recovery is more advanced than leisure, and particularly leisure in and out of Australia.
Yeah, no, it makes a lot of sense. And when we talk to fund managers, I think one of the things that all of them tell us is that capital preservation is something that they focus a lot on. But can you discuss that in respect to where you both sit? We all need to take risk to get return. If we wanted to preserve our capital, we would invest in bonds and get 1 or 2%. Trent, you mentioned before you're hoping for Transurban to sort of generate 4% income and 5 or 6% capital growth. So that's a really good 9 to 10% return for the risk that you're taking above cash. Can you sort of both touch on capital preservation and the sort of return you are looking to achieve because of the risk you take?
Yep. I'll kick things off if you want, Vincent, this time. So preservation, you're right. I think every manager, nobody wants to go and blow up their client's capital. Clearly, preservation of capital should be front of mind for everyone. But for us, I think we would say that we really, it's inbuilt in how we actually even think about risk. I'm often asked, what's the tracking area, the active share, the standard deviation of your fund? And that, whilst we can give you all those numbers, that's not how we think about risk. Our starting point for every investment we make is what is the risk of permanent loss of capital with any investment we make, and the price you pay in listed markets is very, very important there. So we do a whole lot of scenario analysis to work out really what are you paying for today, and these are very large conglomerate businesses, obviously, in some instances that we're investing in. They can be $100 billion market cap businesses, and they may have even 5, 10, 15% of their revenue coming from parts that we would consider to be non-infrastructure. But what if you can get into a scenario where you're not paying for that higher risk part of the business, then that actually gives you comfort to go in and press the button and invest in that company. So it's fundamental to how not just our team, but the whole First Sentier approach to investing is what's the risk of permanent loss of capital when investing. And we do, as I say, a whole lot of scenario analysis to form a view as to what we think the true value of this company is, not just today, but based on all the cash flows that are going to come over the life of that asset.
Yeah, great. Vincent, I might make a comment that one of your directors, Ronnie Chalmers, I don't think would have lost a cent in his life and probably still got the first one. So I don't expect you would be at Clime would be taking too much capital risk with knowing your board very well.
Yeah, fair comment. Yeah, it doesn't hurt to have that influence. Yeah, I mean, capital preservation is a central reason why Clime's process is structured around high quality companies and valuation discipline. If you're investing in a company that's got a net cash balance sheet, particularly if it's founder-led, if it's a market leader in its industry, that does somewhat reduce the risk that there's a significant negative surprise. But that said, investment involves operating in conditions of an uncertain future with imperfect information. So downside risk is very important to consider in the same context as the upside, and also the way that you weight positions in the portfolio. If I use an example of the A2 Milk company, that company's got no debt. It's got over $500 million in the bank, and they've got a strong brand position among Chinese consumers. But sales have been significantly impacted in the near term by the disruption to their sales channels as a result of COVID, including extended wait times for air freight. So then there's a low probability but high impact risk that regulatory intervention in China could materially affect the value of the business. But assuming that doesn't happen and international travel recovers, on Clime estimates, the company could be worth a lot more than where it is trading today, just under $7. So in those set of circumstances, given the risks, we think it's an attractive investment. But given the risk, we do hold it as one of our lower weighted positions.
Yep. And how do you value an asset like that?
Well, for most companies,
it's $7. Are you using discounted cash flows or losing return on equities?
So,
yep.
So risk comes into the discount rate that we use. We don't just use a straight beta type model we have a sort of a proprietary calculation of risk based on some fundamental factors, which include things like negative earnings surprise history, and our quality scoring, which takes into account the balance sheet position, margins, returns on capital, and so forth. So there's a risk built into the discount rate that we're using, and then it goes into the question of how you weight the position, how the risks correlate with other risks in the portfolio.
Yeah. So sort of moving back to infrastructure, Trent. A lot of people use a benchmark to compare their performance to. There's obviously some benchmarks that you can use in respect to infrastructure. Do you look to measure yourself against a benchmark, or are you following the index of the bench, or you and what are you doing to create alpha in respect to infrastructure benchmark investing?
Okay. Well, anyone who's been following the listed infrastructure space would realise that it's still quite a new asset class. It's only really evolved in the last 10, 15 years. And there are a few different benchmarks being used by various managers. The one that we do reference ourselves to is the FTSE Global 50/50 Index. We think it's the most representative of the universe today. But having said that, we would describe ourselves as being benchmark aware, but not constrained. We're not afraid. We build our portfolio very much from the bottom up. I mentioned at the start, there's probably 300 companies that could broadly meet that definition of being infrastructure globally today. There's about 240 of those that are in that FTSE benchmark, but we only have about 140 companies that we consider to be investable. So we are screening out even quite a few companies that are in that FTSE benchmark. So it's a reference. Some of our clients are more, I guess, conscious of that benchmark than others, but it doesn't really drive how we think about investing. What we're trying to focus on is forming a view on what we think the value of that company is. And a bit similar to Vincent, we use a discounted cash flow as the primary valuation tool. It's the best way to be thinking about long dated assets like infrastructure. And then we form a view on quality range on a whole lot of different measures, 25 different measures. But we then rank all those companies. It's what allows us to compare an Australian toll road company like Transurban to a UK utility like National Grid, to a Chinese gas business like China Gas. There's a whole range of different measures that we can use to allow us to be able to compare those companies.
Yeah, and I've followed the CLI fund for a long time. And the NTA discount that it had for a while and closed. And what are you looking to do in respect to sort of certainty on dividend in respect to the listed investment company fund? Have you got a philosophy there where you're looking to pay out all of the franking or a set percentage?
Yeah, the Clime Capital has a real focus on dividends, and regular dividends, and we manage it through the total return. So we'll harvest capital profits to maintain. We aim for like a 6% dividend yield for that entity, and it's got one of the better dividend histories of the listed companies on the ASX. So we're proud of that, and it is a real focus for that company.
Yeah, no, I think it's really good. I noticed the directors of the company are very heavily invested in the listed investment company, and the parent company itself holds a significant holding in the investment company. So, that's always a good sign for me. So, for advisors who haven't sort of seen the CLI LIC, I think it's certainly one you should be having a look at if your clients are looking for fully franked yield.
Thanks. CAM's the ticker there, CAM.
CAM, sorry, CLI is the. You're right. Sorry.
There's
CIW is the other one.
Lots of what's the word? Yeah.
Yep.
Acronyms flying around. That's the
so
one.
Maybe I might shoot to some questions on some stock specific. What are sort of three of the stocks that you're overweight on? Each of you say overweight benchmark that you think that are going to give you some of the alpha
Yeah, I'm happy to go first there. I mentioned ResMed before, and that's one of my higher conviction positions. In terms of benchmarks, we do try to invest very differently to the benchmark. As I said, the Aussie market is heavily weighted to the mega cap, or to the very large cap companies, but we try and invest on on the merits of the investment and how it fits in the portfolio. But ResMed, it's just the share price has come back a bit from $40 in the last month or so, as interest rates have gone up and investor preference has moved away from higher PE stocks. But we think it's the opportunity from this Philips recall is not fully appreciated by the market yet. ResMed is the leader in that space, and this is just a golden opportunity for them to capture share for the long term. And, increasingly doctors are the ones who picked the device that consumers use at the end of the day, and for the next 12 months they're going to have virtually no choice except to prescribe ResMed, and so they're going to have the ResMed experience for the next year, and we think a lot of them will stick around with ResMed. I think there's a desire in the industry that it doesn't become a monopoly, but we think the result is going to be a market dominated by ResMed, similar to Koch in its space. So I think that's quite attractive. To think of what else. Let me just.
Are they sort of taking advantage of all these masks and all these sort of things? Is that one of the points of difference, or is that sort of just a short term?
Masks are very important to the business because the margins, gross margins on masks are above 70% versus a bit under 50% for the machines. And if you've got a doctor prescribing the product, the mask and the machine will typically go together, but they are interchangeable between customers. So Philips is still in the market for masks, but they will be losing share there.
So I think it's interesting to sort of, for the advisor's point of view when they're talking to clients, to be able to relay that type of story, because it's sort of in everyone's face. You can see every day someone walking down the street with a mask, and to invest in a ResMed sort of makes sense to the retail punter. So the fact that it's you're heavily overweight, I think that's a story you can tell.
Well, the long-term dynamics are certainly continue to be in their favour. I mean, sleep apnea is highly correlated or associated with obesity, which has been rising in the developed world in recent decades, and there's a massive under-penetration there. So the long-term growth is very much in play. And we've been speaking regularly. I had a call with a distributor in the US this morning on how this is playing out, and everyone's been saying that it's just an absolute nightmare for Philips and for everyone who's been dealing with Philips through this period.
Yeah, very good. Maybe you'd like to share a stock, Trent?
Yeah, thanks, Gary. So obviously we're a global fund, and we've only really got one or two companies in Australia that are in that portfolio. So you're probably going to be less familiar with some of the names I talk to. But one good example that I often mention for advisors to use with clients is a company called NextEra. It's you may or may not have heard of it. It's actually the world's largest renewable company. It's listed in the US. Its headquarters are in Florida there, and it has close to $150 billion market cap. So it's a very, very large business now. The reason why we like NextEra, and we've been invested there for some time, is that you've got a utility, a US utility, which is located in parts of the US that we like and we favor. And the US is almost like 50 countries when you're investing there from an infrastructure perspective. Every state has its own governor and its own regulation and its own view on how those businesses should be run. So it's actually really important to understand what's happening more at a state level than at a federal level. And the reasons we like NextEra is that they're really on the forefront of making this transition across to renewables. And they're doing it, I touched on it earlier, but they're doing it in a way where they're capturing a lot of that growth and getting it included in their rate base, and therefore earning a more regulated return going forward. So it's probably one of the highest quality management teams that we have come across in our universe. They consistently have been able to deliver around about 6 to 8, close to 8% earnings growth every single year for the last 15 years. and we're forecasting them to do similar type growth going forward. So again, you're looking at around a 4 to 5% dividend yield. You put on top of that, call it 7-8% earnings growth, and it's a very attractive holding for us to continue to have over the medium to long term. So that's probably one example. If I was to give you another one, I can talk to a tower or an airport. I'm happy to go in either direction, but two quite different companies.
Well, I'm very excited you've tipped Nexteris, I must say, because Sequoia launched a specialist investment product only last month on the clean energy series on the US, the index, and Nexteris is by far the largest participant in that index. So I certainly hope you're right from the perspective that we've used a bit of gearing into some specialist investment products on clean energy. So I was pleased when you came out with that name, because when I first saw it, being the number one index participant, I didn't know much about it. So it's very
hopefully
pleasing.
That's all helped you out on a little bit there.
Yeah, no, good.
Do you want another name, or
please.
Sort of happy to keep going? Maybe if I talk to, there's probably two other names I was thinking. One was a company called AENA, which is a Spanish airport operator, and the other being a company called American Tower, which is actually the largest independent tower company in the world. And I might talk to the tower company because I think it's quite topical. It's, if you look at us here today, in normal times, Vincent and I would be standing in front of you presenting, at your PD day in person. Instead, we're all sitting in our homes or wherever we might be, dialed in, and that's playing to a thematic, which is the move to more and more online and digital. And in order for us to be able to do this, you need the infrastructure behind it from the likes of mobile tower operators like American Tower. So again, American Tower, it's an American company. The majority of its assets are in the US, but it does increasingly also have towers in other parts of the world. A management team we rate highly. They've been able to generate very steady and strong free cash flow growth over the last 10 to 15 years. And the reason why we continue to like mobile tower operators is that we're seeing this shift from, you might have heard the terms 3G, 4G, and now 5G.
Absolutely.
And what that's doing is just driving the need and the ability to be able to download more and more data. In a 4G world, if you're using your phone, it would take you on average around about 25 to 30 minutes to download a movie. In other words, you basically wouldn't do it. You'd wait till you got home, you'd be on your home internet, and then maybe you might think about downloading. In a 5G world, you can download that same 2-hour movie in a matter of minutes. So it's a very, very big shift in terms of the ability to be able to use data. We're all now watching sport, movies on the go. And that's driving the need for more and more data, and therefore more and more antennas which are put onto these towers. And if you're a mobile tower operator, the way you generate your income is you have the infrastructure. A telecom company comes and says, right, I need to put more equipment on your tower. They go and they put that equipment on the tower, and it's about a 90 to 95% margin straight to the bottom line for those companies, because the infrastructure is already built and it's there. So it's very attractive earnings for these companies. They have long-term contracts often in place linked to inflation, and multiples and the valuation is always the key risk you've got to look at for some of these tower companies. But that's an example of a tower business that we continue to be overweight today.
Wow. Okay. No, very interesting. I'm actually invested in a little micro cap in Australia that's looking to benefit from putting product on those towers. To support phone to police and so on. So it's a massive thing. Vincent, you're another stock maybe?
Sure. I mentioned the housing thematic before, and I think Adairs is one that we think looks very cheap at the moment. The market's expecting a big reversion of earnings out of the COVID boost, but we think the focus on the home will remain, and then we've got the emerging tailwind of the housing market. So the last few months have been obviously impacted by store closures, but as they're likely trading today, the dividend yield, on go forward cash flows is probably 7%. And we think that's a value stock with growth opportunities, acquisition opportunities. It's net cash balance sheet, so that one looks good. topical also the insurance space. I mean, the banks have obviously had a strong run out of the COVID depressed prices in the middle of last year when they were trading at a discount to book value. But insurance is gaining interest now, and we've been in that sector for a few months now. I think the move up in interest rates has a direct benefit to them and investment earnings. I was doing the calculation on Insurance Australia Group yesterday, and the move we've had up in the last couple of months, that's a 4% benefit to them in terms of their earnings per share. But then also the business interruption insurance. So IAG took over $1 billion in provisions for business interruption insurance claims flowing from the pandemic. They had tried to exclude liability for these changes, but they messed up on their wording and reference to an act that had been replaced. But they've just had a test case decided in their favour, which is being expedited through the appeal process. But it looks almost certain that they're going to get some benefit as a result of that. And in any case, the amount of claims that have been coming through have been well below the expectations, or the very conservative expectations that they used to build those provisions. So we think it's highly likely that there would be quite a chunky reversion of those provisions to profit, either at the February result or the August result next year. And I mean, the industry has been hit from multiple angles over the last 2 years. From the fall in interest rates, we had 2 years which were well above trend. I mean, there is a long-term trend of increasing catastrophe claims, but the last 2 years were well above that increasing trend. So balance of probabilities would suggest that claims will come back from elevated levels, and then the industry is putting premium increases through to restore their profitability. So there's a number of tailwinds there, and we still think the prices are attractive.
And what's your thought on for 100 years the insurance companies have sort of relied a lot on the investment earnings and investing in sort of low risk investments to generate alpha or extra return. Do you think that they're going to start moving outside that risk appetite to sort of more aggressive investments?
I mean, that has to happen to some extent, but they are remaining very conservative, and they have to make up a decent return by putting premiums up in this environment. I mean, the reality is we're in a lower interest rate environment. So I don't think they're going too far up the risk curve. I think it's coming through in the premium rates.
Yep. And what's your thought on so the distribution partners like Steadfast, Austbrokers, PSZ, those sort of insurance brokers that will benefit from rising premiums as well?
Yeah, the broker Steadfast and is they're a direct beneficiary of commercial premium rate increases. That business has proved that it's got a successful model over a number of years. They've been successfully acquiring stakes in businesses within their network. Not sure on the valuation. We're not holding the stock. It may be relatively fully priced, but I wouldn't want to make a firm recommendation on it. But they're certainly well placed in that environment.
I wonder if there's any questions from anyone in the audience. Have we had questions, Mark or Cosette? I'm sort of run out of questions for now.
I'll open it up and see.
Well, I think there's been quite a few comments, but
there's a question that just came up now. What allocation is Interprac okay with of infrastructure within international equities asset allocation?
I would have thought that you could put 25% of your international exposure into infrastructure international. I think that would be okay. So if your total exposure to international was 40%, infrastructure component of that as 10% of the overall portfolio, I think would be reasonable. The stock that you were mentioning in the US, Trent, the code is NEE, is that correct?
That's right, Garry. Yeah, NEE US. So
Next Era is the stock that was mentioned, which is listed, I think, on the Nasdaq. Is it?
It's listed on the US stock exchange.
Yep.
Might leave it open for another minute of questions, but in the meantime, I think that's all we've got.
Very good. Maybe you might want to just wrap up with a sort of a bit more of an advert on your funds. I think we've sort of covered it pretty well. You know, the performance, the long-term performance speaks for itself, in my opinion. And I think you're both tremendous managers. I think what John Abernathy's built at Clime and the team he's put behind him over the last 10 years has been outstanding. And whilst Madison's a competitor of ours, we really respect the Clime team and Colonial First State and now First Sentier have been outstanding. I remember Colonial First State first starting, coming out of sort of the colonial days and people being sort of not sure how you guys would go, but it's just been an amazing journey. And you're not a platform or a superannuation manager now. You're just a very credible AAA class manager. So I think maybe that's your ad, but maybe you want to add to that, guys.
Thanks very much, Garry. I mean, it's been a pleasure being on this discussion. I think if anyone's interested in Clime, reach out to us. I'm sure me or one of the other PMs would be very happy to have further discussions. I think Clime it's been around for 25 years, but we're still a relatively small business in the scale of fund managers, which is a real advantage. I mean, we're well resourced with 12 people on the investment team, but with the funds under management, 650 million Aussie equities, we're still able to invest effectively at the emerging end. And I think, Clime has a great culture. I think, the investment processes and principles, across the industry, there's a lot of overlap, but there are subtle differences in style and process and culture. And I think Clime has a very good collaborative culture, which is proven to be working.
Thank you. And I'll just reiterate there Vincent's comments. So thank you for the opportunity to present today. You've been great supporters of our team and our firm. So if there's any follow-up questions, we really pride ourselves on trying to be as transparent as we can with the investments that we make. We put out lots of research to back up the investments that we have and thought pieces. And reach out, please, to our sales team if you've got any questions or any interest in what we're doing. But thank you again for today.
Thank you. So I'll pass back to the team. I'd like to personally thank Mark, Cazette and Michael for putting on the PD Day today and all of your organisation skills. Doing remote PD days, as I said at the opening on Wednesday of the series, is not our perfect thing. We do like to get together with all the advisors and interact and share ideas. But thank you guys for putting it on a remote basis, and thank you to the speakers. So I'll pass back to Mark and we'll just close out and we'll go out and have some fun now that we're open.
Thank you, Garry. Thank you, Trent. Thank you, Vincent. It was most enlightening. I think you've covered it really well. I do invite advisors if they'd like to have further information on Clime or First Sentier, please get in touch with them. If you can't, get in touch with us here at Interprac. We'll be more than happy to arrange someone to contact you. So again, great job. And I'm not sure, Garry, this brings the final session to a close. Would you like to make a few closing comments to the advisors as we go to party on here in Melbourne?
Just back Zaki in the Koch plate and Invitable in the Melbourne Cup and have a good time. And we look forward to seeing you soon. And, stay safe. Lee asked the question, maybe we can finish off with how do we see work from home on the toll roads? Personally, I think the toll roads will be fine and it hasn't impacted them so far. But you want to finalise that question, Trent? Do you think working from home is going to hurt Transurban?
Well, I'm based in Sydney. If you look at the traffic in Sydney right now, it's back to pre-COVID traffic levels, it seems. So we've seen this trend play out, and it's amazing how quickly it does seem to bounce back with toll road volumes in particular. So I hope we do get all back out and about, but it's fair to say I think there is going to be a bit more work from home than there has been in the past.
Yeah, and I think there'll be some offset. I live in the city and I see the trains and there's no one in the trains. No one wants to hop in the train. They want to hop in their car and not have to sit next to somebody. So whilst you might see less traffic, you'll probably see it sort of balance out. So very good. Thank you guys, and thank you team, and
thank you, Garry.
We'll go and have a beer.
Thanks, Garry. Just before we wrap up, I just remind everybody that there's been a survey sent out. Would you all please fill that in so that we know what works, what hasn't worked, and we thank everybody for putting up the technology. we're going to need a lot more power if we're going to run these sorts of sessions, because we've had a couple of technical glitches, and I just want to thank Cosette for seeing her way through those and without any panic in the background. So
there was panic in the background.
Thanks to everybody, and unfortunately, Roy Maslin just couldn't defeat the wiles of Microsoft and join us, but we'll have another opportunity with Alliance Bernstein in the future. So,
it's quite interesting, Michael. You should take it up with Microsoft, because I know Alliance Bernstein's #1 holding is Microsoft at 5.1% of their portfolio.
Well, there you go.
He can get stuck into them.
It's come back to bite them.
Vince, have a great safe weekend, and have a very special one.
And to all the advisors, thanks very much, and we hope that you've enjoyed it, and we look forward to catching up once we can travel again.
Thanks very much.
Thanks, everyone.
Thanks, Trent. Thanks, Trent.
Bye.
See you, Trent. See you, Vincent. Garry.